This is where SAP training should begin. Not on a screen, not with a transaction code, with 5 televisions. A housing society decides to buy 5 televisions, and we are going to follow that one purchase all the way through. Because before you can understand SAP, you have to understand the business underneath it. That is what the next 34 minutes are for. And by the end of it, you will have watched 9 real business documents cross between 2 companies. Now, most people who start learning SAP begin at the wrong end. They begin at the screens, the transaction codes, the field names, they memorize, and they still feel lost. And the reason is almost never the software. Nobody ever told them what a business actually does. So this is course 0, business before software. In the next 34 minutes, I will not use one piece of SAP vocabulary until the very last minute. We are going to watch a business transaction happen. From the first wish to the last rupee. You will follow one real purchase from beginning to end. A housing society and an electronics dealer. You will see every document that passes between them. The requisition, the quotation, the order, the invoice, and you will always see both sides at once. What the buyer writes and what the seller writes in the same moment. You will watch the goods physically move and find the exact second they stop belonging to the seller. You will learn the 3-way match. The quiet control that stops a company being robbed politely in writing. And you will see where accounting entries come from. Nobody does accounts. The events write the books by themselves. 7 crossings between 2 companies, 1 single transaction, and every piece of it connects. Understand these 34 minutes, and every SAP module after this stops being a mystery and becomes vocabulary. You will not be memorizing screens. You will be recognizing things you already know. This is part 1 of the series. If that is how you want to learn, subscribe, hit the bell, and tell me in the comments where you are starting from. Software later, business first, because here is the truth. None of this was built by software. Business was doing all of this on paper for 200 years. Software came afterwards to keep up. So forget systems. Look at a market. On the left side of your screen, a housing society, 240 flats, 1 community hall, and a committee that meets on the first Sunday of every month. Last Sunday, they took a decision. The hall needs 5 televisions. Remember that number. 5 televisions. We are going to follow those 5 televisions for the next few hours. And at the end of it, you will understand how any company on earth actually runs. Now look at the right side of the screen, the market. And the market has many shops. A small local dealer, an online marketplace, a large organized retailer. The society will go to one of them. Let us say it goes to Reliance Digital. Now look at this picture carefully. 2 companies, completely separate organizations, different offices, different bank accounts, different books. And right now, and this part is important, neither of them knows the other exists. The society has a need. Reliance has the goods. But between them, at this moment, there is nothing. No contact, no paper, no obligation. Everything that happens from here is simply the story of that gap being closed. Before we go further, one small thing, and pay attention here because this one thing keeps people confused for years. When the society does something, we call it buying. Purchase, procurement. When Reliance Digital does the very same thing from its side, we call it selling, sales. But understand this, it is 1 transaction, not 2. 1 event, 2 people describing it, 2 people recording it. When the society writes, we bought 5 televisions, Reliance writes, we sold 5 televisions, same televisions, same day, same price, 2 different files in 2 different offices. Keep this in your head for the whole course. Every single step has a twin sitting on the other side of that. Now come inside the society, the committee meets. The secretary says the hall television is 10 years old. The picture is going bad. The children's room has nothing at all. We should buy new ones. Now let me ask you a question. Up to this moment, has anything happened? Nothing has happened. There is a need. There is a wish. But in the language of business, a wish is not a document. It is not a commitment. Nobody can be held to it. No money has moved and no supplier knows a thing. This is stage 0. And I want you to notice it because in every company, thousands of such wishes are born every day. And most of them die right here. So what does a wish need in order to survive? Somebody has to write it down. The facility manager writes a note. 5 televisions required for the community hall, the gym, the reception and the children's room. Size approximately 43 inches. Needed by the 15th of next month. And he sends that note to the treasurer. Now see what just happened. The need has moved out of one man's head and into the company's records. This paper has a name in business, a purchase requisition, an internal demand to buy. But notice what it is not. It is not an order. Nobody outside the society has even seen it. Reliance Digital still knows nothing. This is a purely internal paper. So why does it exist at all? 2 reasons, and both of them are about control. First, it creates a record of who asked. If 5 televisions turn up one day and nobody knows why, this paper answers the question. Second, it creates a checkpoint for money. Because the next thing that has to happen is that somebody with authority has to say yes. The treasurer looks at the demand. 5 televisions, roughly 2 lakh rupees. He checks the maintenance fund. The money is there. He signs. The president signs. This is called approval or release. And here too a small thing that beginners miss. This approval is not a formality. This is the moment the company accepts the intention to spend. Before this signature, the society had a wish. After this signature, the society has a plan. And still, look at the screen. Nothing has crossed the center line yet. Reliance Digital still knows nothing. Everything so far has happened inside one building. Now the purchasing side starts working. The question is, who can supply 5 televisions? And they will not go to one shop. They will go to 3, maybe 4. Why 3? Because the moment you go to only one supplier, you have no way of knowing whether the price you are getting is a fair price. Competition is not a hobby. Competition is how a buyer protects his own money. And notice how they choose. Not on price, because there is no price yet. They choose on this. Have they supplied before? Are they reliable? Can they deliver all 5 together? Will they invoice properly? Will they honor the warranty? And here begins something we will come back to again and again. A supplier is not a price. A supplier is a relationship. Now the moment arrives. Watch the screen. The society sends a letter to all 3. It says, we require 5 television sets for our premises, approximately 43 inches. Please quote your best price, including delivery, installation and warranty. We need them by the 15th. And that letter crosses the line. For the first time in this story, the 2 companies have touched each other. From the society side, this letter has a name, a request for quotation, meaning tell us your price. Now come with me across the line. Stand inside Reliance Digital and see what that very same letter looks like sitting on their desk. This is the corporate sales desk of Reliance Digital, not the shop counter. The corporate desk, the one that handles bulk customers. The letter arrives. And on this side, it is not called a request for quotation, it is called an inquiry. Same paper, same words, same day, 2 names. Because from the society's side, they are requesting. From Reliance's side, somebody is inquiring. And this is the habit I want to build in you through this course. Every time you learn a document, immediately ask, what is this called on the other side? Now, the Reliance salesperson does not simply look up a price list and reply. Watch what actually runs through his head. First question, who is this customer? A housing society, not a walk-in shopper. A registered body with a committee, with a bank account, with a history. Are they new to us or existing? Second question, do we have the goods? 5 units of the same model in this store, in the warehouse, or will they have to be brought in? Third, can we deliver by the 15th? 12 days. Transport, installation, and technician. Fourth, what price can I give? List price is one thing, but this is 5 units together. A volume discount applies. And this is an institution, so an institutional rate may apply as well. And the fifth question, which matters far more than people think. Will they pay? A bulk customer does not pay cash at the counter. They will ask for 30 days credit. Is this customer good for 2 lakh rupees? All 5 of these are settled before a single rupee is written down. Stop and think about that. Most people assume selling is a game of price. Selling is actually a game of the 5 questions that come before price. Reliance Digital prepares its offer. 5 units, model, specification, 42,000 rupees per unit, 2,10,000 in total, delivery in 10 days, installation free, 2-year warranty, payment within 30 days of delivery. Oh, and it crosses the line. On the seller's side, this is a quotation and offer. On the buyer's side, this is a quotation received. One of 3 they are collecting. Same paper, 2 names again. Now a very important legal point, and hold on to this because the rest of the story stands on it. A quotation is an offer, nothing more. Reliance Digital has not sold anything. They have not reserved a single television. If 10 more customers walk in tomorrow and buy up the whole stock, this quotation will still be valid on paper, but there will be nothing behind it. An offer has a validity. 15 days, 30 days. After that it dies. Why am I pressing so hard on this? Because in a little while we will reach a document that is completely different. A document where the company genuinely becomes bound. And I want you to feel the difference between an offer and a commitment. That difference is the heart of this entire course. Back inside the society, 3 quotations have arrived. The treasurer puts them side by side. Supplier 1, 2,02,000 but delivery in 3 weeks, too late. Supplier 2, 2,20,000, delivery in 1 week, warranty only 1 year. Reliance Digital, 2,10,000, delivery in 10 days, 2-year warranty, free installation. Now watch what they do. They do not simply pick up the lowest number. They are weighing 4 things at once. Price, time, warranty, service. This exercise has a name. Quotation comparison or evaluation. And in a real company it is a formal step, because later somebody will ask, why did you not take the cheapest one? And the answer has to exist on paper. Then the treasurer picks up the phone. Your price is 2,10,000. The other party has said 2,02,000. We like your warranty. We like your delivery. But you will have to do something on price. And now negotiation begins. Reliance replies, we cannot do 2,02,000, but we can give you a 3% bulk discount, 2,04,000, and wall mounting brackets free. The treasurer agrees. Now, a very important point. What happened to the old quotation? It was revised. A new version. The old one is dead but not deleted. The company keeps it because it is the evidence of how the price changed. And notice one more thing. That discount was not invented on the phone. Reliance already had a rule. Up to 3% on bulk orders above 5 units. The salesperson did not create a discount. He applied a rule that already existed. Remember this. In business, prices are not typed fresh every time. Prices come out of rules. List price, customer type, quantity, season, region. The salesperson is choosing from a rule book. Now we come to the most important moment in this whole story. Slow down here. Everything until now, the inquiry, the quotation, the negotiation, all of that was conversation. Nobody was bound. Either side could have walked away. The society could have said, we are postponing the purchase. Reliance could have said, sorry, the model is discontinued. No loss, no complaint. Now the society issues a purchase order. And the moment that document is signed and sent, conversation ends and contract begins. Read what it says. Please deliver 5 television sets. This model at 40,800 rupees per unit. total 2,04,000 rupees to Sunrise Residency Community Hall by the 15th. Payment 30 days after delivery. This is no longer a question. This is an instruction backed by money. From this second, the society is legally bound to pay if the goods arrive on the agreed terms. And Reliance Digital is legally bound to supply at that price by that date. Now, if either side walks away, there are real consequences. This is why I made so much noise earlier about a quotation being only an offer. A quotation costs you nothing. A purchase order costs you everything. Now come with me across the line again. That purchase order lands on the sales desk of Reliance Digital, and what do they do with it? They create a sales order. And I want to be exact here because this is the sentence the whole course stands on. The buyer's purchase order becomes the seller's sales order. Same commitment, same 5 televisions, same price, same delivery date, 2 companies, 2 documents, 2 names. And notice the direction. A sales order cannot exist before a purchase order. Reliance Digital cannot decide on its own that the society has placed an order. The trigger comes from outside, from the other company. If you remember nothing else today, remember this picture, and the moment that sales order is created, 4 things start moving at once inside Reliance Digital. 1. Stock is reserved. 5 units are now booked. Physically they are still in the warehouse, but on paper they belong to Sunrise Residency. If another customer asks, the system will say, these 5 are not available. 2. A signal goes to the warehouse. Somebody has to pick 5 boxes, check serial numbers, pack them and arrange a vehicle. 3. A signal goes to accounts. A receivable is coming. 2,04,000 rupees is due from this customer in about 40 days. That belongs in the cash flow plan. And 4, and this is the one nobody expects, a signal goes to the purchasing department. Because if Reliance Digital does not have 5 units in stock, they now have to go and buy them. Remember this 4th arrow. We are going to follow it. This is the arrow where the story doubles. The warehouse gets the instruction. 5 units, this model. Delivery on the 14th. Now, a small thing that sounds boring and is actually the root of half the problems in real companies. Which 5? There are 40 units of this model in the warehouse, and they are not identical in every respect. They came from different batches. They carry different serial numbers. Some have been sitting for 6 months. Some arrived last week. So the warehouse picks 5 specific boxes and writes down their serial numbers. Because 2 years later, when one of them fails under warranty, somebody will have to prove that this exact unit went to this exact customer on this exact day. Then packing, then loading. Now this is the second big crossing in our story. The first crossing was paper. An inquiry. This crossing is physical. 5 real televisions on a real vehicle on a real road. And a document travels along with that vehicle. A delivery note, a challan. It says 5 units, these serial numbers dispatched from here, going there on this date. Now the question I want you to think about, because this is where business gets serious. At exactly what moment do those televisions stop belonging to Reliance Digital and start belonging to Sunrise Residency? When they leave the warehouse, when the vehicle moves, when it reaches the gate, when somebody signs. This is not a philosophical question, this is a money question. Because if that vehicle crashes halfway, somebody has lost 2 lakh rupees. Whose loss is it? The answer depends on the agreed terms. And that is exactly why a delivery term was written on the purchase order. In our story, the term is this: the goods belong to the buyer at the time of delivery at site. Which means that as long as that vehicle is still moving, those televisions still belong to Reliance Digital. The vehicle reaches Sunrise Residency. Now watch both sides together, because in the very same second, 2 completely different things are being recorded on the buyer side. The facility manager counts the boxes, 5. He opens them, checks the model, looks for damage, matches the serial numbers against the delivery note, and he signs. And the moment he signs, something increases in the society's records. They now own 5 televisions. An asset that was not in their books yesterday is in their books today. This act has a name, a goods receipt on the seller side. At exactly that moment, Reliance Digital records that 5 units have gone out. Their stock falls by 5. Those televisions are no longer theirs. This also has a name, a goods issue. One movement, 2 records, one goes up, one goes down. And here the buyer does something that looks small and is actually one of the most important controls in all of business. They put the purchase order next to the delivery note. What did we order? What did we receive? 5 ordered, 5 received, same model, it matches. If it does not match, if 4 arrived or the wrong model came or 1 is damaged, the whole story stops right here. They record the shortage, they raise a complaint, the seller has to replace. You will hear this again and again through your entire career. Order versus receipt versus invoice. 3 documents that must agree. We have matched 2 of them. The third has not arrived yet. The goods have been delivered. Now Reliance Digital wants its money. So they raise a bill, 5 units, 40,800 per unit, 2,04,000 plus tax, payment within 30 days. On the seller side, this is an invoice. On the buyer side, this is the bill that has to be checked and paid. Now all 3 documents are present. The purchase order says 5 units, 2,04,000. The delivery note says 5 units on the 14th in good condition. The invoice says 5 units, 2,04,000. All 3 agree. Only then is the bill approved for payment. And think about why this rule exists. If a company keeps paying invoices without this check, without asking what was ordered and what was actually received, then anybody can send that company an invoice and get paid. This 3-way match is the thing that stops an organization from being robbed politely in writing 1 invoice at a time. 30 days later, the society transfers 2,04,000 rupees. On the buyer side, this is an outgoing payment, money going out. On the seller side, this is an incoming payment, money coming in. And with that, the story of 1 transaction is complete. Look back at what crossed that center line in order. An inquiry, a quotation, a revision and order, the goods, a bill, the money, 7 crossings. And every one of them was recorded twice, once on each side. That is a business transaction. Nothing more than that ever happens. Now let me show you something that surprises almost everybody the first time. While all of that was going on, the vehicle, the boxes, the invoice, the accounts departments of both companies were not sitting idle and waiting. Their books were being written at the same time the events were happening, not afterwards as it happened. Let us replay the story and this time watch the money instead of the goods. When the purchase order was created, nothing happened in the books. Interesting, is it not? A binding commitment and yet no accounting entry. Because nothing has moved yet. No goods, no money, no bill. At most, the company notes it as a commitment against the budget. When the goods arrived, now something happens. The society has not paid anything yet, but they now own 5 televisions. So 2 things get recorded in the very same instant. On one side, we own something we did not own before. Value has increased. On the other side, we owe somebody. An obligation has been created, but a provisional one because the invoice has not come in yet. This is a beautiful thing and most people never notice it. The moment goods arrive at your gate, before any invoice, before any payment, your books already know that you owe money. The goods themselves created the debt when the invoice was verified. That provisional obligation becomes a real named debt. It is no longer we owe somebody 2 lakh for. It is now we owe Reliance Digital 2,04,000 rupees on the 14th of next month. And when the payment was made, the debt is settled. The bank balance falls. The amount payable to Reliance becomes 0. Now the same replay on the seller side. And notice that it is the same picture, only in a mirror. When the sales order was created, nothing in the books. Exactly like the buyer. A commitment is not yet a number. when the goods left the warehouse. This is the interesting one. Reliance's stock falls by 5 televisions, and those televisions had a cost that Reliance itself had paid. Let us say 36,000 rupees per unit. So at the moment of dispatch, the value of inventory falls by 5 times 36,000 and a cost is recorded. The cost of goods sold. Now think about what that means. Before the bill is printed, before a single rupee comes in, the books of Reliance Digital already know what this deal cost them. When the invoice was raised, now the income side arrives, revenue is recorded, a sale of 2,04,000, a receivable is created, Sunrise Residency owes us 2,04,000 and tax is recorded separately because that portion was never Reliance's money at all. It belongs to the government and it is only passing through, and now the moment every business owner actually cares about. Revenue 2,04,000, cost 1,80,000, profit 24,000. That figure did not come from somebody's calculation at the end of the month. It fell out by itself because the dispatch recorded the cost and the bill recorded the revenue. Now look at both sets of books together and see the symmetry. The buyer's stock went up, the seller's stock went down. The same 5 televisions, the buyer created a payable, the seller created a receivable. The same 2,04,000, the buyer's money went out, the seller's money came in. The same rupees on the same day. 2 independent companies, 2 independent accounting departments that never spoke to each other, and their books are exact mirrors of one another. This is not a coincidence. This is what accounting is. And now the sentence I want you to carry for the rest of your life. Accounting is not a separate activity. It is the shadow that business events cast. In this entire story, nobody sat down and did accounts. The warehouse moved a box and an accounting entry was born. The salesperson raised a bill and revenue appeared. The cashier released a payment and a debt died. Business activity is the body. Accounting is the shadow. A shadow cannot move on its own and a body cannot move without carrying one. Now, remember that arrow I told you to remember? When the sales order was created inside Reliance Digital, 4 things moved. We followed 3 of them. The 4th was pointing off the edge of the screen. Let us follow it now, because I want to ask you a question that looks obvious and is not. Reliance Digital does not make televisions. They sold 5, they shipped 5, they invoiced 5, but they manufactured none. So somewhere Reliance Digital had to buy those televisions from somebody. And now look at what our picture has become. 3 companies, 2 relationships. In the relationship on the left, Reliance Digital is the seller. They receive an inquiry, send a quotation, get an order, ship the goods, raise a bill and collect money. In the relationship on the right, Reliance Digital is the buyer. They send an inquiry, receive a quotation, raise a purchase order, take delivery, check the bill and pay the money. Same company, same day. Both roles. And here is the part that makes people sit up straight. Reliance Digital's purchase order becomes the manufacturer's sales order. Exactly the same handshake we saw before. Exactly the same 7 crossings. And it does not stop at the manufacturer either. The manufacturer does not make his own display panels. He buys them. He does not make his own circuit boards. He buys them. He does not grow the plastic for his casing. So the manufacturer is also a seller on one side and a buyer on the other. And his suppliers are also sellers on one side and buyers on the other. This chain runs from raw material dug out of the ground all the way to 5 televisions on the wall of a community hall in Sunrise Residency. And every single link in that chain is the same 7 steps. This is why we started with 5 televisions. Because 5 televisions is not a small example. 5 televisions is the whole economy in miniature. Now come inside the manufacturer. Because he has a problem that neither the society nor Reliance had. When Reliance Digital gets an order for 5 televisions and does not have them, what does it do? It buys them. Simple. When the manufacturer gets an order for televisions and does not have them, he cannot buy televisions, he has to make them. and making is a completely different kind of work. So the first question inside a factory is this: what is this product made of? A display panel, a circuit board, a power supply, a back panel, a stand, speakers, a remote, cables, 24 screws, packing material, a manual. This list has a name, a bill of materials, the recipe. And notice that it is a tree, not a flat list, because the circuit board is itself made of many components and the display panel of many layers. So there are recipes inside the recipe. The second question: what has to be done? In what order and where? Station 1. Fit the circuit board into the chassis, 20 minutes. Station 2. Mount the display panel, 15 minutes. Station 3. Power supply and wiring, 10 minutes. Station 4. Back panel and stand, 10 minutes. Station 5. Testing. Every unit is switched on, every port is checked. 20 minutes. Station 6. Packing. This sequence also has a name. The routing or the process plan. The recipe tells you what. The routing tells you how long, and on which machine. Between these two things, the recipe and the route, the factory knows exactly what it needs and exactly how long it will take. Now the order from Reliance Digital says 500 units over the next 2 months. And now the factory asks the 3 questions that every factory on earth asks every single day. What do we need? 500 units times the recipe, 500 display panels, 500 circuit boards, 2000 screws of one type, and so on all the way down the tree. What do we already have? Look at the stores. 300 display panels in stock, 600 circuit boards, plenty of screws. So what is short? 200 display panels are short. That is what we have to buy. This calculation, need minus have equals buy, is the most important calculation in manufacturing. Every factory runs it, whether on a whiteboard or in a computer. And look at what it produces. It produces a purchase requisition. The very same purchase requisition we met at the beginning of this course in a committee meeting of a housing society. A housing society that needs 5 televisions and a factory that needs 200 display panels produce exactly the same document and start exactly the same 7 steps. 5 people decided it on a Sunday. A machine calculated it at 2 in the morning. Same document, same cycle. The panels arrive. Now production runs. And watch what happens in the books while the line is running, because the factory is where accounting becomes genuinely beautiful. Components are consumed. Raw material stock falls. That value has to go somewhere. It does not vanish. Labor is consumed. People worked so many hours on this batch. That has a cost. Machines were used. Power, wear, maintenance. That has a cost too. And a finished product appears 500 televisions that did not exist this morning. So the value of the components plus labor plus machine cost, all of it flows into finished goods. And this is where that figure of 36,000 came from. Remember, when Reliance Digital shipped those televisions, we said each one had cost them 36,000 rupees. Now you know where that number was born. It was born on a production line as the sum of material plus labor plus machine time. Follow that line backwards. The cost that decided Reliance Digital's profit on a sale to a housing society was created months earlier on a factory floor by a worker fitting a display panel. Everything is connected. That is the whole point. Now let us step back and look at the entire picture. If I had to compress this whole course into one image, it would be 3 lines. 1. The flow of documents. Inquiry, quotation, order, delivery note, invoice, receipt, paper or its digital form moving between companies. 2. The flow of goods. Raw material becomes a component. A component becomes a product. A product becomes stock, and stock becomes a television on somebody's wall. 3. The flow of money, which always runs in exactly the opposite direction to the goods. Always opposite. Goods flow downstream, money flows upstream. Every business in the world of any size in any industry is these 3 flows. Understand these 3 and you have understood business. Now, in this entire course, I have not named a single piece of software, not even once. That was deliberate. Because software is not the subject. Software is the answer to a problem you have just watched happen with your own eyes. Look at how many places this story can break. An order arrives and the warehouse never gets to know. The goods go out and nobody raises a bill. One bill gets paid twice because two different people approved it. The same stock gets promised to two different customers. The factory buys panels that were already lying in a corner of the store. The books get written 3 weeks later from memory. Every one of these happens in real companies every single day. This is how money quietly leaks out of a business. So somebody said, why not let the order, the warehouse, the bill and the ledger all look at the same record? Why not let the accounting entry write itself the moment the warehouse records a dispatch, because it is one event anyway, only seen from two different chairs? That is all a business system is. Not a pile of screens to memorize, not a list of codes to learn by heart. It is this same story from the committee meeting to the factory floor, kept in one place so that nobody has to tell anybody the same thing twice. 5 televisions, 2,04,000 rupees, 7 crossings, 3 companies, 2 sets of books, 1 production line. And now you know what actually happened. In the next course, we will come back to the beginning of this same story, and this time we will open the system and see how it records every single step.